My name is Tim Craighead. I'm the Senior European Equity Strategist at Bloomberg Intelligence and one of our research directors. And it's my pleasure to act as the moderator today for the Evenco webinar that you all have joined in on, where we'll explore thoughts and ideas about where we're at from an economic or macro perspective and the views and outlooks on positioning across different asset classes, regions, interesting themes and topics looking into 2024. Before we get started, let me just take care of a little bit of housekeeping. If you do have questions you want to ask, please feel free to pop those into the chat. We'll see those. You won't see them yourselves per se, or you won't see others, but we can field them as they come in. That's number one. Number two, let me give just a little bit of a backdrop on Evenco, as well as Bloomberg Intelligence, in case you're not totally familiar. Evenco, an intriguing organization. I've had the good fortune, along with my partner in crime, Laurent Dulay, who co-covers equity strategy with me here, to work with over the last couple of years. Their flagship product, if you will, are fund forums that bring together asset owners and allocators with a variety of different funds. There's actually the first two this year are occurring in London later this month in early February at the Mandarin Oriental. One is on Feb 25, one is on February 1st, I'm sorry, January 25 and February 1st. So if it's something you're interested in learning more about, I'm sure that our friends at Evenco would be more than happy to give you some perspective. Beyond that, Bloomberg Intelligence, in case you're not familiar, we are the investment research shop within Bloomberg. And if you got a Bloomberg, you have us. I'll do this a little bit to share a brief slide. You should be able to see this. Almost 500 of us across our department. We cover everything across markets, across regions, top down from a strategy perspective, bottom up from a company and an equity company credit perspective. We'd love to tell you more, but suffice to say, as I had mentioned, if you've got Bloomberg, you have us. Without further ado, let's get more into the topic at hand today. What we'll first do is have our panelists give a little bit of an introduction to them, their background, and then we'll start digging into the topic. So, Alexis, I'll let you go first.
Yeah, hello, Craig. Hello, everybody. Hello, Tim. Hello, everybody. I'm very happy to participate in this forum, in this webinar. So my name is Alexis Bienvenu. I manage portfolio within La Financière de l'Échiquier, which is also called LFDE, that's the acronym. And we belong to the Banque Postale Asset Management Group in France. I've been managing portfolios for more than 15 years now, and with a specialization in fund selection, because the portfolios that we manage collectively within the team are funds of funds or mandates of funds. So we manage from a top-down perspective, and we use funds as vehicles.
Very good. David, you next, please.
Yeah, thanks, Tim, and a pleasure to be here also. So I'm David Storm. I'm the Chief Investment Officer for RBC. That's Royal Bank of Canada, not Royal Bank of Scotland. So RBC, wealth management in the British Isles and Asia. So we provide discretionary advisory services to private clients and run multi-asset portfolios, so across the whole spectrum.
Very good. And Christoph, last but not least.
Yes, welcome everybody from my side. Pleased to be here. My name is Christoph Kinn. I'm Chief Investment Officer at Markert & Stein in Hamburg in Germany. We are a multifamily office and we do invest in all asset classes, including private markets.
Very good. Look, a wide-ranging set of experiences. It's great to have you all on board. What we'll do over the course of the next, call it 40-ish minutes or so, is work to peel back layers of the onion, so to speak, in terms of macro down to perspectives on markets and dig into exposures and positioning and ideas across certain topics and themes as well. Again, if you've got questions along the way, please feel free to post them. Let's kick things off to begin with the idea of what's going on from a central bank policy perspective, because it does seem to be shaping an awful lot of movements across markets, asset classes, regions, etc. I'll share with you the current view with actually, it's a function on Bloomberg, if you're not familiar with it, MIPR. What this does is to show what the current expectation of central bank policy is, and you can look at it across most countries from a central banking perspective. I've got this on the US as it currently shows. And 2 points I would make with this right up front. The first is the green line is the current expectation, and clearly there's a pivot that is anticipated by the market. It's true here, it's true in the UK, it's true in with the ECB. The other point is the shift in sentiment that's occurred since late October. The yellow line is the October view, and clearly the pivot's coming earlier, the pivot's coming bigger than what was anticipated at that point. With that as a backdrop, I'm curious to get you all's point of view. Where do you think policy is going? Are we still subject to higher for longer, or are we subject to pivot quicker and stronger? How are you thinking about policy? And if we think globally, clearly there's a different policy going on from a Japanese perspective, for example. So yeah, curious. Christoph, do you want to jump in on that?
Sure, thank you. You showed what markets are expecting, and I think it's worth mentioning that markets have been wrong for a long time. They have been expecting rate cuts last year as well. They didn't happen, they didn't materialize. But I think there's something different right now, because now the Fed itself has pivoted. If you look at the last Fed meeting in December, it was quite clear that Jerome Powell now has transformed from a hawk into a dove. So I think these rate cut expectations are have a much better base right now, and the development in inflation rates also speaks for that. So we see inflation rates coming down quite quickly. But nevertheless, markets may seem to be a bit too aggressive in what they expect. So March may be too early for a first rate hike. We've just had the inflation numbers coming out from the United States, which disappointed. They have been higher than expected, and it was the same in the Eurozone. So it may take some time before actually central banks will cut. We expect them to do that in the second quarter. And I think there's still some obstacles in the way to really fulfill all the rate cuts the markets are expecting.
Yeah, David or Alexis, do you want to jump in?
Yeah, I think. Oh, sorry, please. When you go.
As you like. Thank you, Christoph. We share this view that the assumption of the markets are reasonable, that they are well based on what Jerome Powell said. But if there should be a surprise this year, would it be on the upside or on the downside of the rate cuts? I mean, more or less rate cuts. And for us, if there was a surprise, it probably would be more on the downside. I mean, on more rate cuts than anticipated, because we have a relatively cautious or perhaps pessimistic view about the US economy. We have seen some weaknesses, mostly in the employment activity in the employment rate. So we would bet that if there is a surprise, it could be more rate cuts than less rate cuts, actually.
Very good, David.
Yeah, and I think that's fair as well. You know, you've got to also think that there's risk on the other side too, right? There could be less rate cuts, and I guess it's our job to be able to lean in and lean out depending on where the market pricing goes. In what we saw last year, you know, to follow on from Christoph's point, you know, the market was wrong very many times, and it seemed to only take a couple of data points to really switch the narrative from it's a recession. Oh, you got to cut to completely to the other side. And we saw that over the course of the year. I think we'll see something similar over the course of this year, probably not as violent in terms of the swings. So as asset allocators, as investment managers, you know, I think it's going to be an interesting time. We probably have to be more dynamic with risk allocation than we probably had to be through every year until around about 2020.
Very good. And I certainly would echo the sentiment shifts. It's interesting. I won't bring it up. I've got another chart that looks at what's transpired with factor investing over the course of 2022-23, and you know, whether it's value, growth, size, a series of other things. You know, the dramatic volatility within and relative to each other. You can mark like clockwork with the shifts in sentiment on central bank policy to the degree that it's been such an underlying driver of the markets over the course of the past 12 months. So interesting to pick up on Alexis, your view about more pessimistic from an economic perspective.
Yeah.
I assume that means you're in the recession camp as opposed to the soft landing camp.
Yeah, more. Yeah, we are biased toward this camp. Yeah, it's true. Of course.
Yeah, go ahead if you want to.
Yeah. I mean, if you look at the actual data, they are still good. I mean, from a GDP point of view, it's still okay. Probably around 2% or a bit more in this quarter. In the last fourth quarter of 23. So it's still okay until now, but there are some signs of weaknesses, and mostly on the PMI side from the manufacturing activity is picking down. So that's a bad sign. And if you look at the job creation, they are oriented downwards, of course, and you have more partial work time. You know, the employment has been degraded, not as a number, but as the quality of the employment has been badly oriented. So there are many signs that activity is or will be smoother, will be lower in the future, even though until now, of course, it's true that the numbers are strong. Another factor to take into account is that the fiscal stimulus that has been given by Biden administration last year will probably have to smooth and to be less effective. So next year could be a year of reduction in the fiscal stimulus, and that will be a large part of the story of next year, probably. That's our point of view, at least.
Oh, very good. And I'm happy for either David or Christoph if you all want to jump in, but I also want to shift gears as we move from macro into markets. But any concluding remarks when it comes to economic growth, whether it's U.S., European, or elsewhere?
I would like to comment on what Alexis just said, because you rightly mentioned the massive fiscal stimulus that we have in the United States, and I think this is the exact reason why we will not see a recession. So on the one hand, that's good news, and the bad news is the costs are pretty high. So we have massive fiscal debt. We have a massive increase in new treasuries. And I don't see that changing next year, no matter who will be president. So even if Trump will become president, I don't see a cut in fiscal spending. It's just a redistribution away from green energy to oil industry. But I think he's not. He does not has the reputation of a big saver on the opposite. So that is my view.
No, very good.
Yeah, if I may, Tim,
yeah,
I'd
please, David.
I think what we might expect to see as well is, I mean, we've not seen it in inflation. It's been pretty uniform across the globe coming down. But when it comes to growth, we might expect that to be a little less uniform. So we could see more differentiation between, let's say, the prospects for Europe, as Alexis said, and the prospects for the US, as Christoph has said. And then I'm sitting in London, so I feel I should mention something about the UK. Of course, it's, you know, probably of the three areas mentioned, probably the most interest rate sensitive, and so could also suffer on growth the most. So we expect to see a bit more differentiation, and maybe that will drive eventually a differentiation in central bank policy. At the moment, they all seem to be singing from the same basic hymn sheet.
Yeah, no doubt. And I think we would concur. Our economists, for what it's worth, from a UK European perspective, I think have marginally gotten a little less concerned. Our US economist continues to be more on the Alexis point of view, from the standpoint of marginally more pessimistic, but at any rate, interesting to go through. If we take that backdrop, and in particular what transpired with the shift in central bank policy, I want to share a couple more pictures and sort of evolve into market dynamics. But to get a sense of where we stand with that shift in policy mindset starting in late October, you know, the 10-year as a case in point, in either the European or the US marketplaces, went from the red box in the left of higher for longer and marching up into late October to then just plunging as we got into November, December. Equity markets, you know, I've used a little bit of a longer period of time in the right panel, but regardless of US, European, Asian, most markets took off like a rocket starting early November, and most are at record or near record highs. I could extend this back to 2000, and we'd obviously all see that and we know it. Credit markets, whether it's US or Europe, have also tightened quite markedly, and we're basically back to pre-pandemic levels. So clearly, you know, there's nothing wrong in the world of credit, and there's no credit cycle coming. And lastly, in fact, thinking about no credit cycle, there's been far more rising stars in the world of, say, European credit than falling angels, where there's been a paucity of downgrades. So, you know, it seems like there's a Goldilocks scenario that is being embedded in the market at this point. How concerned are you all thinking broadly about asset classes? Is it too rosy? And is there a market in particular that you're watching or are concerned about given what's baked in right now? Anybody want to jump in on that one?
Well, perhaps if you like, I
Please.
can begin. But yeah, it's a bit too rosy for us, even though we have to admit that the pivot of the Fed is strong, and that's a good justification for the rally. But the only the probability point, the problem here is that there is almost no hypothesis for a recession in the next year in the US, and even the European recession doesn't translate into the market numbers. And the European recession is almost a fact now. So we are around zero, or perhaps a bit minus zero at the moment in GDP growth in Europe. So for us, the market has been a bit too rosy, and as a consequence, we would avoid the most leveraged part of the market, like the high yield, or the most expensive part, like the mega cap technology, for now, at least from a tactical point of view, perhaps not on the long term, but for the tactical point of view, it seems overstretched in valuation. And on the contrary, with perhaps more dovish or less hawkish Fed and ECB in the next months, probably, we could have a better direction in a mid and small cap space. So we would be less large cap and more mid and small caps in the portfolios.
Oh, very good. Christophe or David, want to jump in?
Yeah, maybe I can add that my biggest concern here are long-term interest rates, government bond interest rates. I think this is where the market is maybe wrong. I don't think that equity markets or stock markets are wrong, but I think they may be wrong on 10-year government bond yields. Why do I say that? I think it's not only about inflation coming down. This is the reason why the market has rallied so much. But long-term interest rates is about expected inflation. It's not about the actual inflation rate. And expected inflation always has been quite low. And you can even see that expectations there are pretty flat or sometimes even are going up. So no reason for a rally here. We have a massive supply coming. I mentioned that already. So US Treasury supply is increasing by 23% this year. The Fed is not buying anymore. So who's going to buy that and at what yield levels? The curve is still inverted. This is not the rule. This is the exemption. There's no term premium in long-term interest rates. So I wouldn't be surprised to see long-term 10-year government bond yields higher at the end of this year than they are right now.
Very interesting. David, what stands out to you? Oh, you know, David, before you jump in, sorry, I have to show one more little slide on the heels of what Christophe just said, just to give a picture to his comments. This is UK gilt supply and Euro area supply. These are on net bases, and you can see that there is a wall of supply coming. Now, this is European, and you mentioned, you know, the US element of things, but it is imposing. There is no doubt. So, you know, at any rate, just put a little support behind your argument, Christophe. David.
Yeah, it's certainly a lot of bonds for DB pension plans to swallow up, or for retail investors to appear from money market funds to lift those. I think the main thing that we're focused on, and maybe it goes back to my initial answer, is this idea of yes, we think the market's pricing a very, very benign outcome. Obviously, it's given up a bit of the overshoot since the start of the year. And for me, the issue is, and you mentioned this, Tim, it's almost like there's a whole cluster of factors that just trades one entire way on central bank policy or central bank policy expectations. So dollar rates, small cap, you know, Europe is all pricing off the same thing. And it's certainly at index level, it's getting harder to think about where diversification is coming from in portfolios, which is, you know, one of the things that we have to solve for when you're entering. I mean, we've already been through a number of years with high levels of uncertainty, and this year looks to be no different. So it's just thinking about where diversification is going to come from in portfolios to make those robust enough to work in a number of different scenarios.
Sorry, I hit mute for a moment. That's very interesting, and you know, I totally get what you're talking about from the standpoint of correlations moving, you know, like lockstep at times. What about the 60-40 concept? Is that still valid? Anybody have a strong thought there?
I think it is, but the way that you interpret it is very different, right? Or the way that different people interpret it is very different. You know, 60-40 bonds, equities, right? In bonds, I can buy convertibles or high yield, and they're quite equity-like. In equities, I can buy, let's say, I don't know, utilities, and they're quite bond-like. So I think there's always been a lot of flexibility built into 60-40, but the way that broadly investors think about it is this sort of binary portfolio that has these two return streams. I don't think it's dead, but equally, it's something that came out, you know, 60 years ago, and none of us are using the same telephone that was around 60 years ago. You know, markets have evolved, the portfolio tools that are available have evolved. So maybe you can just implement the same thing, but a little bit more efficiently these days.
Yeah, very good. Any thoughts on that, Alexis or Christoph?
Yeah.
We can keep moving.
Well, I agree that the 60-40 model portfolio was an old-fashioned concept and had to be rethinked, but it has been actually redefined since 22, because in 22 both parts of the portfolio went down sharply, and then the premium on the bond space came back. At least not really the premium, but at least the carry came back, and the protection against a little bit of inflation came back. So I think that this old concept of 60-40 can be used again in our environment now, because we now have a decent bond carry, and it makes it interesting again.
Oh, very good. Makes sense.
So my view is a bit different here, because I work with a completely different kind of clients. So I think 60-40 is more for institutional or retail investors, but the family office portfolios that I look after are very much tilted to equities. So almost no bond exposure. But bonds are back there, but they're not at 60, they're maybe at 10 or 20. But they play a role, but a much smaller role than in any 60-40 portfolio.
Oh, very good. Last question from the macro, and then we'll dig into some topical thematic things maybe. Central banks, we talked a lot about central bank policy, and there have been sort of shifts from the standpoint of, are they going, or are they not? And maybe that's market interpretation as opposed to necessarily central banks themselves shifting. I think, shoot, which one mentioned, Christoph, maybe that Powell has finally now shifted. I mean, you can see it in his commentary. What's the potential risk that they overshoot? That if they do start easing, that they've eased too quick, too fast, and the whole tightening cycle has been for naught. Any concerns about that?
I think the good news is that they're not going to ease 300 basis points on day one. It's going to be a number of adjustment cuts. You can even just do, the first 3, let's say, wait and see and pause. So I think it's actually pretty well set up, whether it was by luck or judgment from the central banks. I think they're almost in a pretty good spot.
Very good. Well, let's shift gears. One of the big topics that I think will be unusually relevant and interesting this year is about politics. And I guess I tend to be of the view quite often that politics are interesting for people and for communities and nations and all of us individually, but they're not necessarily usually that interesting from a market's perspective. But I will share a slide again, because we do think this is pretty extraordinary in 2024. There are 40, maybe it's even more, but at least 40 big general elections. It's 40% of the world's population. It's 40% of the world's GDP involved, and it's everything from Taiwan this weekend to the U.S. later in the year, along with a number of European, Middle East, African, Americas, other Asian countries. What do you think about politics this year? Are there any of those that you are particularly focused on, that you are thinking about, that you're concerned about? Anybody want to jump in there?
Yeah, I mean, it's hard not to be concerned by U.S. politics, is it? Because we all depend on it, and the markets will pay a very large attention, of course, to it. And if Biden wins, that will not be at all the same as if Trump wins. This year, for example, probably Trump would not have done the same IRA law as Biden did, so there would have been perhaps less growth, perhaps less fiscal deficit, I don't know, but it would have been a different world. So it really matters. Of course, I don't know, you don't know, nobody knows who will win, but I guess the market is not so afraid by Trump as he has been, as the market has been in the last, at the first Trump election. But the second thought I would have is that perhaps one of the most interesting parts of the world is not voting, and it's China. Because if you have three powers in this world today, you have China, you have the US, so there is a concern, of course. You have Europe, but Europe is not really voting, is it? Because they will vote, of course, but there will be only for the, the European Commission, not for the states, member states. In France, for example, it has been done already. We have Macron, now we have a new prime minister, In the UK, it will come, that's for sure. And in Germany, it has been done already. So the main driver of the Eurozone will not vote on a national level. And then you have China, and in China, as you know, there will be no democracy this year, probably, and that would change the things. So, I mean, the voting part of the population next year is not at all representing the importance of the economy. And apart from US, the rest doesn't matter that much from my point of view, I guess. And from a market point of view, of course, it matters for people, for economy and for politics, but for a market point of view, I don't think it will be that important.
Christophe or David?
Yeah, I'd like to add that election years in the United States are usually good equity years. So there's a positive correlation here, no matter who wins. And I think I wouldn't say that markets have been afraid of Trump in 2016. I think Europeans were afraid of Trump in 2016.
Yeah, right.
If you look at the equity traders on Wall Street, they were mainly pro-Trump because they said he will give us tax cuts, and we saw a massive rally after Trump was elected because this is exactly what he did. I don't know. I have my doubts that this is the same this time because we all learned that Trump and also the pro-Trump's traders on Wall Street, they learned that he can be very erratic in what he does. And this is something that markets usually don't like. And we have to be honest, nobody knows what a second term will look like. It will be very much different from the first term if we will see it, but nobody knows how it will look like. And so I have my doubts that this time, even if Trump will win, a rally might be that big as last time.
Yeah, David, any thoughts?
Yeah, I mean, I don't think the US election really becomes tradable until, the second half of the year anyway. That's when investors will turn their attention to it. But I definitely echo Christophe's thoughts. I'm not looking forward to, it would have been Twitter in 2016-17 that became a key part of the investment process. I guess this time around it'll be Truth Social. So that sort of, you used the word erratic. That erraticism is not something portfolio managers look forward to. And obviously there's risks on the fiscal side, there's risks on the tariff side, there's risks on the geopolitical side, not least for Europe and NATO. So these are all things bubbling in the background, but I think until the second half of the year, we probably don't think about them. Of course, Alexis mentioned election in the UK. That's going to come this year as well. If it goes in line with polls, and we know that also might not be the case, it could be that the UK leans more heavily into Europe, which may actually be pretty beneficial for the UK and indeed, just by the by for UK assets.
So I'll layer in a couple of additional thoughts. Number one, I'd echo, David, what you just said about the UK. I mean, within my own work, I tend to focus on UK markets, and my partner focuses on a lot of the rest of Europe. And you know, whether you're Labour or Conservative, I think the expectation we would have is, you know, if it shifts, and clearly the market would say it's going to shift. A, there's more of a pro-European stance potentially, and B, there's potential for more investment. And whether you like that or you don't, you know, it could play well, at least from a domestic element of the marketplace. So we'll see where that goes. Second thing,
Tim, I would just
please.
like to add on that. I think the UK has a real advantage with respect to the election year that you've mentioned, that we don't have a threat of a right-wing political party there. And this is true everywhere else. So I think this is really speaks in favor of the UK.
That's an interesting point. And you're right, there isn't that risk. Which actually goes to the other couple of comments I was going to make. I don't think we have a strong view from an Indonesia perspective in terms of who will win or not, but the leader right now is someone who could have an impact on accessibility restrictions, where Indonesia leans politically, and it's a resource-rich country, so it's one to keep watching. And India, you know, has been a really intriguing economy, a growth story, a market that clearly has outperformed many others from an emerging market perspective. And you know, Modi hasn't had as clear and direct of a positive path over the last year as had been the case, and that election is going to be an interesting one to watch as well. So two big populous economies, obviously different from an economic impact from a global perspective, but interesting ones to stay on top of with potential investment ramifications. The other thing from a U.S. point of view that I think is interesting is the Supreme Court, which historically, you know, again, didn't have that much of a market impact, but to the degree that it has shifted as it has, and could shift further again if he's back in and there are more retirements, and he fills it even further with the right side of the equation. This is as unprecedented of a year as it is from an election perspective. It's also quite unprecedented from the standpoint of what the Supreme Court is going to be making rulings on. And so that's another element that sort of plays into the same sort of broad bucket to stay tuned and watch. So enough on that. Last but not least, this weekend is going to be intriguing for Taiwan, and we have certainly no expectation that the wheels are going to come off the bus when it comes to U.S.-China relations. There's lots of reasons to think that clearly both sides of that policy argument about Taiwan don't want anything that turns hot or turns problematic. But I don't know what any of you all had seen, but our geopolitical economist, really interesting lady, Jennifer Welch, had written a couple of pieces over the last week or two on Bloomberg, going through scenario analysis and sort of gaming what different types of shutdowns of Taiwanese semiconductor supply would mean to the global economy. And I'll share one more picture because I think it's pretty shocking. If you had a total shutdown of Taiwan semiconductor supply, our economists' sort of shock impact would argue it's a 10% impact on global GDP, twice as big almost as what we saw with the global financial crisis and COVID. Not to make a mountain out of a molehill and go crazy on this, but you know, the world lives on semiconductors now, and Taiwan is where it's at. There's obviously all sorts of stuff to discuss about that, but at any rate, it's one of those items to keep in the back of your mind. Speaking of China, what about China's views on China's progression economically, and what do you think about from the standpoint of are you looking at exposure there potentially? And clearly it's underperformed. The valuation is pretty extraordinary. Or you could shift gears and not necessarily talk about China directly, but its implications for emerging market asset classes or its implication for other regions just economically. Any thoughts on China?
Yeah.
Yeah, jump on in.
Yeah, it's a very complicated subject, but we went wrong on China. We thought the rebound would be okay last year, and we were disappointed like many others. And so we trimmed the exposure to China, and now we stay very cautious. We don't bet on a market rebound, especially. Of course, there could be a good surprise, but it's been so complicated to allocate on this country that we prefer to stay away from it. Not totally, but more than we would have done a couple of years ago.
Yeah, there's no doubt that the bar for international investors to engage in Chinese assets has definitely moved a lot higher. I mean, but if you think about, let's say, an all-country world index, China's still not a huge amount there, like it's 3% roughly. I would say our own thinking around this is, China's almost moved from being a core position to now something that we think about a lot more tactically.
Yeah.
I don't think anybody's expecting the big bazooka stimulus to come out, but we do expect some degree of stimulus over the course of the year. It's just how successful that is really in solving problems around, the continuing drag from the property sector. Okay, solve that, and then try and really engage with consumers to help boost domestic consumption in China. Yeah, and then you asked about implications for the rest of EM. Well, clearly, China is a significant part of EM. A lot of countries are connected to Chinese growth. India probably not, but a number of other countries for sure, and then Europe as well. So there are far-reaching consequences of China's impact on global growth in very specific areas. So I think we're hopeful, but in terms of direct exposure, yeah, we're very much like Alexis. It's very limited and definitely very tactical.
No, very good. Christoph?
Yes, I think it's important to remember that the China equity performance was really disappointing, even at times when China was growing very fast. And now the story has completely changed. Growth rates have come down. We see a lot of crisis. The real estate market is in dire straits. And the political leadership has changed completely, and the priorities have changed completely. So the economy is not on top of the agenda there. So it's very hard, given all these facts, it's very hard to convince any investor, any private investor to go to and invest in China, even if the market may rally for some months. Many investors say, well, okay, I don't care. It's just not something I want to be invested in.
No, fair enough. And I would throw in a couple of comments. I won't show a chart this time, but we have done some interesting analysis, I think, on Europe's exposure to China. It's a lot more important to Europe than it is the States. For a host of reasons, whether it's things like luxury goods or autos or industrials, etc. We had identified 80 companies with significant China exposure. It's 30% of MSCI Europe. From an index weight perspective, it's 20% of average revenue. Granted, it skews in various ways. UK and Germany are the biggest exposure from a market perspective, and it matters. So we're certainly watching quite closely. And our folks in Hong Kong who cover China property, are intrigued. They've written a lot about what the most recent policy changes are, which seem to be moving towards almost a Singapore style of social housing and taking advantage of the overstock of unsold property and moving it in that direction. That, it's not going to be great because the price that would be paid is not what a market would have paid before the crisis, but clearly it's better than nothing and could be one of these things to stave off more distress, more defaults, and actually get sales and starts moving back in a positive direction. So we'll see where that goes, but interesting to watch. How about we shift gears? I know we're running a little tight on time, and I want to hit on at least one last topic. Probably one of certainly the biggest drivers, and some would argue biggest hype factors of 2023 is AI. Are you a believer, or do you think it's all an overhyped, Gartner Group hype cycle, and we went up the curve and now we're going to go down the curve before reality ever comes and sinks in with whatever it's going to eventually mean? Any strong views on this and how you might position as it relates broadly to tech, however you might think about it?
So maybe I start here. So I think there are good reasons to be optimistic that AI will improve productivity very much, and this will be beneficial for a lot of companies, and this will be beneficial for the whole economy and for growth. So I share the general optimism, but if you look at who is really making money from AI at the moment, and if you just have a very narrow focus, you end up almost only with NVIDIA, who make tons of money with that. I think it's already a reality in many professions and in many companies, but it's very hard to really quantify how much that increases the value of a business, and if that does justify the stock market increases of the Magnificent Seven stocks we saw last year. But I think it's not a bubble. It's not something like we've seen in during the tech bubble at the beginning of the 2000s, where we were basically trading hot air. So it's a reality, and we don't need any fancy devices to use AI. It's our reality. Everybody is using it every day and everywhere. So it's here to stay. But I think you have to really make up your mind who is really benefiting the most from that.
Yeah. Alexis, David?
Yeah, I agree with Christophe. And I would say that AI will probably help the AI names like NVIDIA, perhaps also Microsoft and so on, but they will also help the general productivity and then the whole economy and stock market. So for me, the real opportunity in AI is not only in AI, but also in globally the whole market, and especially the service, because probably it will be more useful for the service companies than for the manufacturing, even though perhaps there could be a debate. But on the long term, it will help the whole market. That's my point.
No, fair enough. Dave?
Yeah, I think at the moment, you look, markets are still just rewarding the enablers of AI. So NVIDIA, the Magnificent Seven. But also, you don't have to own NVIDIA. You can own TSMC. You can own different stocks all the way down the conductor value chain. So there are different ways that you can implement a view on AI. Once we're over the enabler phase, generally what happens is you're going to move on to the companies which are very hard to identify that will really benefit from adoption of AI. I'm sure most of us use some minor degree of AI somewhere in the process, even if it's just getting ChatGPT to translate fact sheets or write code. Don't tell compliance. But just different companies will definitely adopt better, and they will benefit. And I think that's the phase that we're at, trying to identify the companies in that broader spread now, or broadening out of the whole thing.
Oh, very good. I'd toss out a couple of things. One, if anybody's interested, we do on certain topics, themes, industries, pull our research on Terminal together into deep dive hard copy reports. And we wrote one late last year on AI and how it could be a $1.3 trillion market by 2030 plus. Lots of detail in here in terms of where and how it works from a technological perspective. I think is worth taking a look at. There's one coming up shortly in the next couple of weeks about the tech supply chain, and clearly that will play through a lot from an AI vantage point also. Point number two, our view, and it was supported by a recent CIO survey that we just finished up, is not only is AI at the early phase of last year being sort of experimental, but 2024 actually seeing actual full-scale development of projects that will have implications, going back to what all of you all said from the standpoint of improving productivity or the way businesses work. But we also think that there's a resurgence in tech infrastructure spend that is coming for a host of reasons, AI being one of them, but it's not the only reason. And so there's a wind at the back of technology as we see it that's pretty intriguing, notwithstanding things like valuation that obviously you also have to take into consideration. And the last thing, we just published our 50 focus ideas to watch. Focus ideas are high conviction ideas within our research team, and around the globe, across sectors. And 9 of the 50 were AI related. And yeah, Alphabet was one. But it also goes down to applications like Match, if anybody's into using Tinder or Hinge, which is incorporating it as well. So it is quite the spectrum of how AI ends up being, a technology. There was maybe we finish, because we are running towards an hour. There was a question that came from the attendees. Any specific strategy or funds to keep an eye on in 2024? And I guess I would translate that to, if you thought about a strategy or an area right now that you're particularly interested in or doing work on, or you could say avoiding like the plague, either side of the equation, what would it be?
I could mention 2 strategies that we are actively working on and implementing in the portfolios. So the first one is the steepening of the US curve, and probably also the European curve, but the US is most obvious. So we are long on the short maturity and short on the long maturity. And the second strategy is to have more mid and small caps, especially small caps, quality small caps with a sound balance sheet. And we think that the valuation of this market is compelling now. So we are back on this.
It's funny, Alexis, because we differ somehow on our view on interest rates, but we also like the steepener for different reasons. So
Right.
You're a bull steepener, we are a bear steepener, but we can agree on the steepener. So that's quite funny. I'd like to add something on equities. We look a lot at small and mid caps because as we all know, last year was equity markets have been dominated by just a few very big stocks, and the big question is, when will the broad market pick up? And the small caps already had a kind of comeback in the second half of last year, and so the big question is that lasting? When will be the right time to go in there? So usually the best time to go in there is after a recession. So are we in a recession? When will it end? And when is the best time to go in there?
Oh, maybe just round out. I'll say we're kind of focused on strategies focused on dispersion. So whether that's within equity credit, because we think there's going to be greater differentiation, especially as you see greater issuance over the course of this year. One other thing that we've really focused on in portfolios is just this continued idea of how do we hedge against geopolitical risk. Obviously, there's heightened geopolitical tension in the Middle East right now. Commodities is considered, the classic way to do it, but we actually prefer that to do that through commodity long short. We think that's a more effective portfolio hedge than just long commodities. So you just get that increase in volatility that creates better opportunities. So I think that's a good portfolio hedge in a year where we're going to face political and geopolitical risks.
Oh, very good. Look, I think we covered an awful lot. There are questions that we didn't get to. There are questions that came in that I think we, from the audience, several that fed into elements of what we did discuss. So really appreciate people popping comments and questions in. And with this, I think we can successfully bring this webinar to a close. Really appreciate all the time and the attention from a sustained audience. And I'd remind folks of the fund forums coming up January 25th and February 1st with Evenco in London. And then that only starts what will be a succession of fund forum events across the rest of the country. And clearly from a BI perspective, we'd love to have anybody connect in with us from an equity strategy perspective. We do have a distribution list. We send a little weekly message out on Fridays. And if you're interested, send me an email or a LinkedIn or what have you, and we'd be thrilled to add you to our list. Why don't we bring that to a close? Alexis, David, Christoph,